Welcome to the Money and Mortgages podcast. I'm your host, Adam Coleman, accredited financial counselor and mortgage planner. Join me as I speak with fellow industry experts on all things personal finance. Well, welcome everyone. This is Adam Coleman, and with me today we have Austin Coley, a certified financial planner with McCollin Associates out of Brentwood, Tennessee. On this episode, we're going to be discussing effective ways to build in charitable giving into your financial plan. So, Austin, welcome to the show.
Yeah, Adam, thanks for having me.
Well, jumping right in, I guess, why is charitable giving important from a planning perspective in your mind?
Yeah, it's a great question. Charitable giving, from my perspective, is important, just like any passion that an individual or family would have in their life as far as something that they want to plan for. Charitable giving at the heart of it is at the root of it is a heart to give and share what you have with others for a passion or a cause that you care about. And it literally is taking money that you could spend elsewhere and instead using it to benefit others. And so families that have that inclination, I think it's such a noble cause, noble passion. And luckily, the government gives us some incentive for planning charitably through the form of tax deductions. And so from my standpoint, whether it's, planning for charitable donations or planning for retirement, planning for gifting to kids, it all comes back to the root of what's important to the client, what they're trying to achieve through the resources that they've been blessed with. But if charitable giving is something that means something to them and an endeavor that they want to take on, then luckily there's a lot of really cool planning avenues to go down to make that happen.
Nice. Well, you mentioned a few, like from a tax deductible standpoint, what specific gifts are you seeing that are tax deductible?
Yeah. So gifts, I think, can mean a couple of different things. The first is a gift to a person or an individual or a family. A lot of parents, when they get older, start to advance their inheritances to their kids, right? Let them actually see the use of that inheritance. And so those gifts actually are not tax deductible. If you're giving to your children or to a person, there's no tax deductibility with those gifts. And in fact, if you give too much, you could potentially run into some estate tax issues. But I guess you can get into that another time. But what we're really talking about is gifts to charity. So 501c3 organizations. So any gift that you make to a 501c3 will be deductible from a tax standpoint. Now, there are a couple of provisions in there. You can't give 100% of your income and deduct it in a certain year. I think it's 60% for cash, 50% for securities, and there's a 30% in there as well. So there are some things you'd want to check with the CPA on if you're giving. But from a large part, any gift to a nonprofit is tax deductible. And I think the important thing to remember from a deductibility standpoint is there's a difference between something being tax deductible versus a tax credit. And I think people get that misconstrued a lot. So a tax deductible item, so a gift to a charity, isn't necessarily if you give 5,000 to a charity, you can't just take $5,000 off your tax bill at the end of the year. Really, what you're doing is you're taking $5,000 off the income that you've made in that given year, and then whatever your tax bracket is, whether it's 12, 24, or even 32, or it's 37, whatever that percentage is of your gift is really actually your tax savings. There are some things like tax credits where you get a dollar for a dollar knockoff, but a charitable gift is not one of those.
Gotcha. And I think we'll talk about this a little bit more in detail, but in terms of taking the tax deduction, we're talking itemized deductions, correct? There's not really any scenario in terms of gifting that you can take the standard deduction and get the gift deduction, correct?
Yeah, so all charitable gifts, kind of like mortgage interest or healthcare costs, they're considered below the line deductions, meaning if you compound all those deductions and they don't exceed the standard deduction, which is around $30,000 for couples this year, then you're just going to take the standard, which, by the way, I was interested to learn that 87% of Americans take the standard deduction, 87%, which is a huge number, obviously.
I'm curious if that's 87% people should take the standard deduction, or maybe some of them are taking it, but they didn't realize there were some of these things that could add up enough to where the itemized deductions would be high enough. But yeah, I mean, obviously the standard deduction being so high now versus what it was in the past, for my world too, on the mortgage side, a lot of people aren't getting that mortgage interest deduction. So it changes the conversation there as well. Although with rates being higher now, that's starting to come into play where a lot more people are itemizing the mortgage interest. So that could potentially lead to more additional deductions you could get from charitable giving as well. So maybe we'll see that more as time goes by, as people are buying houses at higher interest rates too. So we'll see how that impacts things. For people that are charitably inclined, I guess, what are the most tax effective ways to give for charity, especially for somebody kind of in that accumulation stage? Because we'll talk about retirement later, but for the younger people that haven't hit retirement yet, what are some of the major tools that you're going through with clients in that age range?
Yeah, yeah, good question, Adam. So the most effective tool that we've seen clients use from a vehicle standpoint is a donor advised fund. And a donor advised fund is basically a way to get money out of your possession in the form of a legal gift, but not yet disperse that money to a charity. So basically, it's a vehicle hanging out there in space where, from a tax deduction standpoint, you've technically gifted it, but it has not yet entered the possession of a charity yet. It's kind of in limbo. And we can get into kind of the benefits of using a donor advised fund a little bit later, but that is one of the biggest tools that I've seen individuals and families in the accumulation phase use for charitable giving. The other is giving highly appreciated securities. And so a lot of times, I've got clients who were gifted shares of Amazon or Apple or Tesla by grandparents, and those were not stepped up because they were given to the individual. And so they've got a growth of 1,000% in some of these shares. And so, I mean, what do you do with that? Do you sell it? You can't really, because it's a huge gain. And so one effective way I've seen clients use those high appreciated securities, instead of giving just cash to the charities that they care about, they'll instead give those highly appreciated securities. That way they are not impacted at all by a huge unrealized capital gain. And then if they want to continue to own those shares, that's great. We can just go back and repurchase them with cash, just completely step up the basis, but we're able to get that huge gain off the books, which is a really cool way to give. And it's easy for your broker, for your clearinghouse to just transfer those appreciated shares where you're actually never even liquidating them. So that's the second. The third is if a client has a high income year. So let's say they sell a business, have stock options that they exercise. They have a huge spike in income in one given year. Obviously, their tax bracket is going to be impacted because of that. And so if they're all of a sudden in the 37% tax bracket, well, it makes sense to give quite a bit in that year if they're able to, especially with the increased income, to take advantage of larger tax savings than in a normal year, if they're in the 22 or 24% tax bracket. So that's another area that we really try to work with clients. And obviously that takes a lot of planning on the front end as well, anticipating that, because once you kind of get through December 31st of that year, it's tough really to make any sort of impact. And then the last thing I'll share, and this goes for retirees as well as these accumulators that we're talking about, is converting assets from a traditional IRA to a Roth IRA. We call that a Roth conversion, essentially taking pre-tax money and getting it into a tax-free vehicle. The downside of this is that any money that's converted from a traditional IRA to a Roth IRA is taxable from a taxable income standpoint. And so what we've done a lot of times is matched charitable gifts along with Roth conversions. So that way it's a tax neutral event for a client. And even more so, instead of just giving cash to match that Roth conversion, we'll give appreciated securities, kind of taking it back to step two there. So we're getting a little bit extra tax savings. So it's always fluid with accumulators because life's changing. People are having kids, buying new homes, going on vacations, right? There's a lot of moving parts. So it's kind of a year to year thing, whereas retirees, you can sometimes plan it out a little better, but there are vehicles for people in those shoes.
And you mentioned some of this, and I think you kind of already addressed it, but in terms of the deadline to deal with most of these things, in terms of gifting, is it typically December 31st on all things that you're talking about, or is there ever a time where it goes through the next tax due date, like April 15th?
Yeah. So, I mean, Roth contributions, IRA contributions, SEP contributions, all that stuff can go a little bit into the following year.
Right.
But for charitable gifts, it all has to be done by 12/31. And I'll say, like, from our stance, we cleared through Raymond James or a broker dealer. A lot of times you have to initiate that stuff kind of beginning of December just because so many people are trying to do charitable giving stuff at the end of the year. And so if that's something that you want to do, I'd recommend around Thanksgiving, you really start thinking about it so that way you don't run out of time.
Gotcha. And hopefully by then you've got a pretty decent handle on where your tax bracket is to make those kind of planning decisions as well. So maybe don't do it right at the beginning of the year when things might change. It makes it difficult to plan, but towards the end, but don't wait too long. So that's good advice. Well, you mentioned one of the big ones, obviously, and that's kind of one of the things that we wanted to dive into deeper here is the donor advised fund. So, can you maybe dig a little deeper into what that is, kind of how it works, and how it's exactly helping taxes beyond kind of the summary that you gave earlier?
Yeah. So the donor advised fund, again, to recap, it's this vehicle where you're able to give money and retain some possession. We'll get into that, but the funds do not go to the charity yet. And so the real benefit of this is to be able to technically give cash in years where either A, you have high income, but you're not ready to write a huge, huge check to a charity yet, or B, you want to take advantage of a strategy, which we'll talk about, called bunching. And so how it works is you'll have to, at your brokerage firm, set up, Adam, you said a donor advised fund. Typically, that's run through the trust department of your broker dealer or the brokerage firm. And so when you decide to give securities or cash to this donor advised fund, you are technically the trustee of of the donor advised fund. You're not the owner, meaning that once you give these funds to the donor advised fund, they're completely out of your possession. There's no taking that money back. If something happens and you need funds, if you've gifted it, it's gone. It's out of your estate, it's out of your possession. But at that time, the money's sitting in a fund. Think of it kind of like an HSA in the sense that you can invest the money inside of the donor advised fund if you'd like. You can leave it in cash. There are a lot of options on how you can invest it. Usually you can invest it in funds, you can invest it in stocks, you can invest it in bonds. Again, there's a lot of options on how you can invest this money. And then when you're ready to give the money to a charity or multiple charities or gifts over multiple years, you're able to do that out of your donor advised fund. And so from our circumstances, there is no requirement to give any money out of a donor advised fund in any one year. For Raymond James, we have a requirement because it's technically a nonprofit organization to give 5% of the total amount in Raymond James donor advised funds in a given year. But you, as the individual, do not have a requirement to give any. If you want to give it all in one year, you can. If you want to give nothing in one year, you can. If you want to get over multiple years, you can. But the beauty of it is really you want to go ahead and get into some of the tax deductibility and tax benefits of the donor advised fund from a bunching standpoint, because this is really where I've seen clients take the most advantage of a donor advised fund through bunching. So we mentioned that the standard deduction from a tax standpoint for individuals that are married is, I think it's $29,200. So let's just call it $30,000. I think that's an easier number to digest for people listening and watching into this. So if the standard deduction is $30,000, and again, a charitable gift is a below the line deduction, meaning that we have to give, plus in conjunction with mortgage interest, medical bills, other things like that, we have to combine all of that for more than $30,000, or it really doesn't matter. So if you give $15,000, the mortgage on your house is $10,000 and you paid $3,000 in medical expenses, that's 28 grand. The standard deduction is still bigger, so you would still choose the standard deduction. So I run into a lot of conversations with clients where they're given $15,000, $20,000 a year, but they're not itemizing because they're simply not getting over that $30,000 number. And so what we've done, if they have excess capital or again have really even better, these appreciated securities that they're not planning on touching. What we'll do is instead of them just continuing to write 15, $20,000 checks year after year, we'll pick a year. Hopefully it's in a high income year. And I'll say, Mr. or Mrs. Client, why don't we give $40,000, $50,000 to a donor advised fund this year? And then the next year and following year after that, we'll give $0 to, charitably. So how that looks is in year one, the client will write a $50,000 check, or we'll move securities, or however we'd like to fund the donor advised fund. We'll move it into the donor advised fund. Since we've given $50,000 in that one year, we'll add the mortgage interest of $10,000. We'll add the medical expenses of $3,000. All of a sudden, the client has $63,000 worth of itemized deductions that they're able to take advantage of. And they'll be able to chalk that off their regular income. Again, hopefully in a high income year, which would be huge. And then the next year, they've got this donor advised fund that they're able to give out of. So the charities aren't impacted. They're still continuing to receive the same funding that they were before. But instead of it coming from John and Jill Smith, it's coming from, the Smith Donor Advised Fund. And then in year two, from a tax deduction standpoint, they'll take the standard deduction, which is $30,000. In year three, they'll take, the standard deduction, which is $30,000. So in example one, if they took the standard deduction all 3 years, the total would be $90,000, right? $30,000
Right.
for each year. But in the scenario where we're utilizing bunching for a donor advised fund, they're able to take, $63,000 worth of deductions in year one, $30,000 in year two, and $30,000 in year three. So we're able to deduct an extra $33,000 by doing the exact same thing that they were going to do before. I mean, that can add up to huge tax savings for people. So that's really the biggest way we've seen clients use a donor advised fund.
Nice. Well, speaking of, I guess, the more intricate, issues of donor advised funds, are there any kind of limits to that, like contribution limits? And then also, are there any income limits before they can actually get the deduction?
Yeah, so from a contribution standpoint, I believe there is a limit to open a donor advised fund. I know for us at Raymond James, it's $10,000. Other places, I'm sure it's different amounts. So not a huge barrier to entry there. We're not talking, hundreds of thousands of dollars that you need for one of these. And the best way that I can kind of compare it to something, it's kind of like a private foundation. You heard of like the Gates, Bill and Melinda Gates Private Foundation. It's kind of like that, but less expensive. You don't have to file tax returns. So a lot of people see a donor advised fund and think like, wow, I've got to have a lot of money to do something like that. And the truth is that's simply not the case. We talked about the disbursement of capital inside of the donor advised fund. Really, there's not a requirement year after year to give it to a charity. So let's say you have a feeling that you want to support a cause, but you're not sure what that cause is yet. But you have a high income year and you want to take advantage of this bunching and donor advised fund. You can contribute capital to the donor advised fund and just let it sit there for 5, 10, 15 years and grow. And then once you become aware of what that cause is, then you can start distributing the capital. But there's no requirement year after year. And then from an income standpoint, I think all that there's no income requirement, but I think you have to really work with your CPA to think, does it really make sense for us to use this donor advised fund in the grand scheme of our planning? If your total income for the year is very, very low, it probably doesn't, right? But at the same time, if you're in a high income situation or just really want to take more than the standard deduction and you're able to do that from a gifting standpoint, then I think a donor advised fund really makes sense to look at. And I think the downside, which we do need to acknowledge, is, in our scenario of taking those 3 years of gifts, instead of giving 15 a year, like you're writing a check for $50,000 in one year. So you have to have the capital to be able to do it and also the willingness to get that out, knowing that you're going to continue to pad it on the back end.
Right. Gotcha. Are there any restrictions in terms of what types of charities are available? Let's say you just threw in a bunch of money into a donor advised fund and realized, there's not really anything that I want to, or my charity's not listed on here. Is it that specific, or are they fairly pretty wide open when it comes to different charities that are accessible?
Yeah, so they're pretty wide open. Raymond James has a list of organizations that, for lack of a better term, are vetted, right? Their team has reached out and confirmed that it's a legitimate 501(c)(3) organization. But we've had plenty of clients that want to give to organizations that aren't on that vetted list. And so what we'll do on our end, I'm not sure how it works with, again, other firms, but on our end, we'll just submit a recommendations to Raymond James Charitable and say, client wants to give to charity ABC. Here's the EIN number. Here's the contact. It'll take maybe a week for Raymond James to look into it, and they'll say, yeah, this looks good. And we'll go ahead and write the check. So there is a list, but I've not yet had a charity that somebody wants to give to that's been denied. For it to be denied, there's probably a bigger issue behind why it's being denied, and you don't want to give to that organization anyway, to be honest with
Right.
you.
That's probably good to know that information before you start contributing too much money to it if they're restricted for some reason. So, what happens if the person has donated to this and then passes away? I guess what happens then if they haven't actually used the money sitting in the donor advised fund? What are the next steps there?
Yeah, good question, Adam. And a lot of families use these donor advised funds as kind of family legacy charitable funds. And so what happens is for example, when you set up a traditional IRA, Roth IRA, or a 401(k), you'll name a beneficiary. So if something happens to you, then that person takes ownership of the capital and the account. Donor advised fund, because it's not technically in your possession anymore, you can't name a beneficiary, but what you'll name is a successor trustee or trustees. And
Okay.
so, say, Adam, you have a donor advised fund, you name so and so as the successor trustee. If something happens to you, then that person would then take ownership of dispersing the funds. So we've seen a lot of families honestly pull in their adult kids and really be able to come up with a common mission, common mentality, and rally behind an idea of this is what we believe and these are the causes we want to support. Fund this donor advised fund, which will, with a large pool of capital. And then the legacy of those parents continues to live on long after they're gone because the children are still communicating with the organizations and giving out of the fund.
And just to clarify, I guess, just so that nobody's confused, this is not the same as needing somebody to set up like a revocable family trust to handle like avoid probate and things like that. You don't have to have your own separate family trust. This is completely separate and related just to the donor advised fund, correct?
Yeah, correct. It's totally separate. It's a lot simpler. And again, because the money is out of your possession, it's out of your estate too. So really there's no trust involved except for the trust that technically owns the donor advised fund from a technicality standpoint, which would be your firm's trust.
Gotcha. Are there upfront costs or fees associated with it, or is it very similar to like a traditional brokerage account where maybe you just have expense ratios or things related to whatever investments you pick, but does the fund itself have additional fees?
Yeah, so anytime you're dealing with a trust department, which handles the donor advised fund, it's going to be a little bit more expensive. And when I say a little bit, I'm talking about a little bit. If you're setting up a regular account at Fidelity and you're not hardly being charged anything, setting up the donor advised fund, yeah, you may pay a few basis points more, to cover the trust department expenses, but I wouldn't say that the expenses should deter somebody from doing this because it's not significant.
Gotcha. In terms of investment options, it's pretty much the full spectrum of options, correct?
Yeah, yeah. So again, there's really no restrictions on what you can and can't invest in these funds. What I will say for anybody that has one of these funds is from an investment standpoint, be very careful on bucketing the assets inside. Know what capital you want to distribute in the next couple of years. Make sure you're protecting that. And then the assets that you're okay, if you're not going to distribute for 10 or 20 years, let that money grow and expose it to some more risk. But you just want to be careful to bucket those assets to make sure that it matches the time horizon.
Gotcha. Okay. Is this fairly easily doable for a DIY investor? Or are these types of investors typically needing to go through somebody and have a dedicated financial planner? Or is it accessible through like a Fidelity or Vanguard, like from a DIY standpoint?
Yeah, Fidelity and Vanguard both have donor advised fund options. And so it's just as easy as finding that department on their portal and walking through the steps. Again, I haven't gone through Fidelity or Vanguard to do it,
Sure.
but I know that it shouldn't be a big barrier to entry.
Nice. What are, I guess, major mishaps that could happen with this that people need to avoid as they're thinking about donor advised funds?
Yeah, so I think you need to have a large scope when you're dealing with this. People get very caught up in their tax bill year to year. And so, to save money on taxes, they may want to write a big check to a donor advised fund, when all reality, they may need that capital down the line to take on ABC project. And so once you give the money, it's gone. There's no taking it back. So I would just be careful to make sure that the capital you've earmarked to benefit these causes and to put into a donor advised fund or give to a charity is capital that you truly want, to benefit the causes you care about. And if you
Gotcha.
have a large tax bill in a given year, not just writing a big check because you may need the cash later. And then the second thing I'd say is, again, from an investment standpoint, just like you would in a regular account, as far as managing it for when you would need the cash, do the same thing in a donor advised fund. You don't want to expose near-term cash. When I say near-term, I mean short-term, 6 months to 18 months. You don't want to put that in the market and expose it to, a large amount of volatility, because the charity could get a lot less than, you intended. So I always hedge on the stance of being more conservative and just bucketing it for, the time horizon that you're ready to make the gifts from.
Gotcha. Does any of this strategy change when you hit retirement age versus accumulation stage?
Yeah, yeah. So there are a couple of options that become available to you that I think make a lot more sense that didn't necessarily make sense when you're accumulation stage. The one is using a QCD. So what a QCD is, it's I guess to take a couple of steps back. If you have a pre-tax account, so when I say pre-tax account, like a 401k or a traditional IRA, once you turn 72 or now 73, in 10 years, 75, the government's going to start making you take money out of that account. The reason is they want to tax it. They're
Yeah.
saying, you've let it grow tax free long enough. We're ready to get our hands on some of this. And so even if you don't need the cash, you will have to start taking some out and then paying income tax on that. And so the situation a lot of our clients find themselves in is, again, they're given 10 or $15,000 a year out of their bank account. They're having to start taking this required minimum distribution. And what happens is it just increases their income amount just a little bit. And they're just continuing to write the checks out of their bank account. So one tax strategy that you can use is, instead of taking the money from your IRA and just putting it into your bank account and then writing the charitable gift out of your bank account, instead, your brokerage firm can send your required minimum distribution directly to a charity that you care about. You can't contribute it to a donor advised fund. That's one thing that's
Right.
not approved yet. But you can send it to a charity you care about. And because you're never taking possession of those funds, it never actually counts as regular income. So the biggest benefit of this is in scenario A, if you're given 10 or $15,000 just out of your bank account and you take possession of the required minimum distribution, you're still going to claim the standard deduction. But in scenario two, where if you just send the money directly from your traditional IRA to the charity, because you're not taking possession of it, it's, I guess, for lack of a better term, an above the line deduction. And so
Right.
you're able to kind of deduct that required minimum distribution because you gave it away and still claim the standard deduction of $30,000. So it's a way really to maximize your tax deductions in retirement if you're taking required minimum distributions.
Nice. Well, no, this has been perfect. I really appreciate you taking the time. Is there a better way to find more information about you and your firm if somebody wanted to learn more?
Yeah. So again, our firm is McCall and Associates. We're based out of Brentwood, Tennessee. The best way to find us is to just go to our website, www.mccallandassociates.com. If you want to get in contact there, I also have a Calendly link. Just type in meetwithaustin.com. It'll flow straight to my Calendly, and I'd be happy to talk about charitable giving, give my thoughts on what you're doing, or, any other way we can help. So, Adam, I so
Nice.
appreciate you having me on. This has been a lot of fun, man.
Yeah, no, I appreciate it. This is great information. So I appreciate you taking the time. It's been always a pleasure.
Thanks.
All right. Thanks, Austin.